In the beginning of March, we had stated that considering credit spreads at that time were near levels more consistent with recessionary periods, the then emerging rally in corporate bonds had further to run. Since then, corporate bond credit spreads have tightened appreciably and have returned to levels that are more in line with their long-term historical averages. Having reached these more normalized levels, this rally has lost steam over the past few weeks. Going forward, we are concerned that we could see another bout of volatility in the second half of the year. While both economic growth and job growth in the U.S. remain positive, both have been slowing. For example, the sequential annualized growth rate of U.S. GDP has declined for the past 3 quarters. U.S. economic growth has declined from 3.9% in the second quarter of 2015 to 2% in the third quarter, to 1.4% in the fourth quarter, and most recently to 0.5% in the first quarter of 2016. In addition, the April non-farm payroll report only increased by 160,000 jobs. Not only did job growth significantly miss the consensus estimate, but also came in well below the lowest estimate of the range. Treasury bonds, though, have performed well thus far this year. Treasuries traded higher as investors sought a safe haven from volatility earlier in the year, and have then held those gains as investors have reduced their expectations that the Fed may raise short-term rates here in June. In fact, based on interest rate futures, the market is not pricing in a greater than 50% probability of a rate hike until January 2017. Year-to-date, the Morningstar U.S. Government Bond Index has risen 3.37%. Our corporate bond index has increased 5.4%, and the high-yield market has rallied 6.42%. After such strong gains, this is a good time for investors to reevaluate the amount and the type of risk they're willing to accept in the bond markets and reallocate their investments to make sure that they're in line with their investment goals.